Hello and welcome to Noble's Emerging Growth Equity Conference. My name is Pat McCann. I'm an analyst here at Noble Capital Markets. Today we have Mike and Per with us. They are the CEO and CFO, respectively, of Orion Energy Systems. They're going to go through the presentation. At the end, we'll get to some Q&A. So if you do have any questions, feel free to drop them in the chat, and we will get to as many of those as we can at the end. So with that, I will turn it over to you guys.
Great. Thanks, Pat. As Pat said, I'm Mike Jenkins. I'm the CEO of Orion. I will walk you through an overview of our company and then happy to answer your questions at the end. Our company was founded in 1996 by an entrepreneur, and really our organizational mission hasn't changed a lot since then. We really are in business to help our customers achieve their sustainability, energy savings, and carbon footprint reduction goals through our technology and service. As you'll come to see, we're really a hybrid organization between a product organization and a manufacturer, as well as a service and integrator company. This is our leadership team, our officers, myself, Per, who's with me on the call, and then our head of our services group, Scott Green. I like to say this is our business on a page. So on the left side of this, we have three different segments or platforms to our business. Lighting is our heritage and our largest segment. Specifically, we're in the retrofit lighting space, which means that we are converting a company's lighting in situ from one technology to another. The company was originally founded by taking companies from high-pressure systems and converting those to fluorescent, and that was about a 50% energy savings for customers. And now we're going in and helping customers convert from fluorescent technology to LED, and that's another 50 or 60% energy savings. Even more when you apply sensors and controls on top of that. Our next platform is EV charging. We entered this space in October of 22 with the acquisition of a company called Voltrek. Voltrek was a regional provider out of the greater Boston area, a turnkey provider of EV charging installation solutions. Its trailing 12-month revenue was about $5 million prior to our acquisition. We just closed at the end of our fiscal 24, where they did 12.4 million. So they're scaling nicely, and I'll talk more about the future of that business coming up. The last segment is our maintenance segment, and this is lighting and light electrical maintenance. So we really view this as kind of a service to a lot of key accounts. Our largest account is our largest overall account, and lighting account is also our largest maintenance account, with about eight figures, about $10 million in contracted business per year with them. On top of that, we acquired a company called Stay-Lite Lighting a number of years back in January of 22. That in the maintenance space, typically the customers have 3-year fixed price contracts. So the good news is there's recurring revenue there. The bad news for us is when we acquired Stay-Lite Lighting, we had a number of customers with fixed price contracts. And at the same time, we had rapid labor inflation over the last couple of years and found ourselves underwater on a number of these contracts. And so we're really faced with a profitability challenge there. We've been very public about that, have worked through that over the last 2 quarters. This quarter, which we're in our quarter 1 right now, and our quarter 2 are transitional periods for us as we have scaled back and out of unprofitable contracts, and really expect that maintenance business to return to solid performance in the second half of the year. We're 100% commercial and industrial focused as a customer base. Our sub verticals underneath that are industrial manufacturing, commercial office. Retail for us typically is big box retail. Automotive is both for OEM automotive producers as well as dealerships. Logistics and warehousing is a very large vertical. We're involved with some of the largest warehousing and logistics firms in the world. Healthcare is hospitals typically. Agriculture is a small one for us. That's a legacy one, that's dairy. And then public sector is a growing area of importance. Right now, we're in the process of wrapping up a $9 million Department of Defense project over in Germany. We do a lot of work for the federal government, for states, municipalities, schools, and universities under this segment. We're very unique. We have three paths to market. So while many lighting companies will manufacture product to be put on a shelf, everything that we manufacture for the most part has a project associated with it. Sometimes one path is our distributors and agents, lighting agents will bring us projects. We work with them. Another big area is with ESCOs, and ESCOs are energy service companies who are in business to help other businesses reduce their energy intensity and footprint. Lighting is just one portfolio for them. We provide them product just like we do on the distribution side. And on the turnkey side is really where we leverage both our product expertise and service capabilities. And so on turnkey, we can do everything from going out and doing site audits with customers, engineering a solution for them, custom making and producing product, installing it, commissioning the sensors, and being there for maintenance and for warranty work if needed. Therefore, based on that, our revenue streams are from product, our turnkey services, our maintenance business, and our EV charging business. We're fortunate. We have a lot of, we think, very favorable macroeconomic and environmental factors right now in the business and for the foreseeable future. Energy prices, while they move up and down directionally, are going to continue to increase. The U.S. is going to become more and more energy intensive. AI itself is a huge consumer of energy. So anything that can offset some of that consumption, like moving customers from fluorescent to LED, is going to be very important moving forward. Climate and ESG, even though that can be a bit political at times, this is a huge motivator for public companies with targets that are out there to decarbonize. And the nice thing for us is when companies make a commitment around climate and ESG, those are C-level commitments, and those definitely stick. EV revolution, we'll talk about that moving forward. Some of the earlier projections were quite bullish, but this is still going to be a growing business, and the linchpin for this business is EV charging infrastructure, and that's where we play. Regulatory, for the first time ever, 7 states are banning the sale of fluorescent fixtures and replacement tubes starting in January. The largest state is California. It's bi-coastal. More states will follow. So what this really means is moving forward in those states, you will not be able to buy fluorescents of any kind and will be forced to convert. It's definitely having an impact. Right now, we're seeing it in customers in those states, and especially large multi-site organizations are accelerating their conversion to LED. There's been a lot of federal funding which has come that will impact us favorably, like the NEVI funds, which came out of the infrastructure bill. That's $5 billion to support DC fast charge infrastructure to support the interstate highway system. That's moving forward. LED penetration, we're only 30 to 40% through the whole conversion to LED. A lot of that happened in the first, some of that happened in the first 5 years of the 15-year journey that we're in right now. So we can go back and relight those customers. And then there's a lot of federal funding, which is, or federal emphasis on Buy America and Build America, Buy America. And we qualify for both those programs. On the lighting side, we've done over 25,000 projects. We've got a very strong focus on commercial industrial, as I mentioned, exclusively focused. Interior and exterior applications, deep controls and sensor experience, including IoT. This is going to be a more and more important area of this business overall with the advent of AI and the connection to business management system, building management systems. And so these sensors and controls are on each luminaire and provide not only control of that luminaire, but also can gather data on their environment. We have multiple channels to market, as we said, and a lot of repeat customers. Maintenance side, we've already kind of covered that. And on the EV side, we primarily do turnkey installations, again, similar to lighting. We use ChargePoint and ABB as our preferred equipment partners. We do level 2 and DC fast charge, which also can be used for fleet. The business was regionalized when we acquired it. We're in the process of nationalizing it, both in terms of capabilities as well as cross-selling it with lighting customers. Typically, the payback on the lighting side of our business for customers is 1 to 4 years. And that's because we have the highest lumens per watt portfolio in the industry. Lumens is a metric for light, and watt is a metric for energy. So the more lumens per watt you get, the more efficient your portfolio and the lower energy consumption it would generate. We have a 266,000 square foot manufacturing and assembly facility here. This is a picture of it right now. And so we do manufacture the majority of our interior product in the US. We do have product which comes from abroad on the exterior side, and then some of the more competitively price point products as well. These are customers. A lot of these are repeat customers, logos which all of you are familiar with in different spaces, retail, manufacturing, government, Department of Defense, Postal Service, etc. Case study that we're very proud of, and you'll see it in our financials. If you look at the last 5 years, you'll see that the company took a huge uptick in revenue for a couple of years. That was really due to this large project, which was a $250 million project for us, which played out over 2.5 years. It was for a large home improvement retailer where we retrofitted 2,000 sites for them. We did it not only in terms of manufacturing custom product, but we managed the whole project from auditing stores to manufacturing the product, to installing it, to commissioning and maintenance on the other side. So we set that up with a future-proof sensors and controls platform where they'll be able to manage each one of their luminaires independently, and as I mentioned earlier, gather data. And this whole project, which is a $250 million outlay for them, paid back in less than 1.5 years. I mentioned already we're BAA and BABA compliant in terms of our product offering, which is a big deal, working with the federal government, state, municipalities, and schools. One of the advantages we have is because we are a domestic manufacturer, we can keep components in relatively deep positions and then customize at the last possible moment. And that allows us to have the lowest lead time in the industry of 2 to 3 weeks versus our competitors, which typically are 2 to 3 times that. This is an example of our portfolio. This is our interior portfolio. These little metals down here indicate where we fall in terms of lumens per watt or efficiency. So you see a lot of number ones and 1 through 3 here. So very high performing products in our space. This is our wet room, parking deck kind of portfolio. And then these are exterior lights over here. So the same thing, we operate at the high end of the spectrum. We do offer more price competitive products as well. So we get more, let's say, a broader view of the market, and then hopefully can either sell at that level or trade up. This chart just illustrates our capabilities on the sensor and control to go from very basic on-off dim. So you enter a room, the lights turn on, to full IoT capabilities like I referenced before for our case study, where they're able to control each luminaire independently or zone them and gather data on the environment. This will become a bigger and bigger area now with the advent of AI. Our turnkey capabilities, this really separates Orion from others in our space. Again, we can do everything from, this is kind of vertical integration. And so we can go to that large customer. We won that project, that $250 million project, over companies that were probably 10 times our size because we were able to offer them a central point of accountability and manage the entire project for them without intermediaries directly involved. We talked about the lighting market already, being about 30 to 40% of the way through. Still a huge amount of the market to go and a huge amount of the market to be redone from the early days. Our maintenance unit, as I mentioned, was started around a key account, our #1 account, which we do about $10 million a year in revenue with on the maintenance side of the business, and then subsequently bought Staylight and now have contracted that business due to profitability issues. And again, we'll be through that in the first half of this year. And these are customers, clients we've worked with on the maintenance side of the business. EV charging, we're very excited about. Again, that business was $5 million before our acquisition, top line. It was finished at 12.5 this past year. That just ended in March. Our budget for this year is 18 plus, so approximately 50% growth. And we do expect the EV charging infrastructure business to be a $30 to $50 million business for us in the next couple of years. It's a full turnkey business, as referenced earlier, ChargePoint ABB, primary equipment providers that we work with. Lots of logos that you would be familiar with. Again, the business was New England centric, so that's what the client base represents. We are cross-selling those with the rest of our national lighting customers. We have over $30 million in our pipeline of just generated from cross-selling, both EV solutions to lighting customers and lighting solutions to EV customers. Different equipment providers that we've talked about. I know there's been a lot of noise about EVs and the adoption of EVs. So this chart is the latest I could find, comes from B of A, June 5th. Their projection now is that 25% of the new vehicle fleet by 2027 will be EVs. Again, the linchpin on this conversion at any level is EV charging infrastructure. So whether this number is 15% or 30%, basically it's the same infrastructure that's going to be required, and that's where we play. I think I mentioned earlier about the NEVI funds, $5 billion in federal funding, which has been appropriated to the states and is now working its way through. This is to connect the interstate highway system with DC fast charging units. That's going to play out over the next 5 to 10 years. There's more state and utility funding coming. As an example, Massachusetts, another $300 to $400 million to support EV charging. And a lot of businesses are looking at electrifying their fleets as well, which will be another key driver. Oops. This is an example, small case study here of where we electrified a pilot for Boston Public Schools. It was $1.5 million project for us. They did about 20 to their first 20 of 100 buses. They're now working on second phases, which we expect actually to make those projects to initiate relatively soon. From an ESG standpoint, as I mentioned earlier, we help our clients reduce energy, which is a huge environmental benefit. We certainly feel like we walk the talk. In addition to everything we do for our clients and customers to help them achieve their sustainability objectives, 20% of our energy consumed is renewable, 12% of that is site produced. From a demographic standpoint, we're definitely over manufacturing average in terms of female, both in our workforce, at leadership, and 60% of our board of directors is outside board is female. And then from a governance standpoint, everything you would expect from an FCC company. Performance last year, we did grow about 18% on a year-over-year basis. Every one of our segments grew. Lighting was about 8%. EV was essentially 100%, and maintenance was around 40%. So that drove that 18% growth. We said this year the maintenance is going to contract by design to focus on profitability, about $5 million this year. Even with that, we're still guiding to a 10 to 15% growth rate. Our margin did improve last year by scale, so a lot of in our cost of goods, there is absorption that plays there on a margin basis. So as we grew, margin expanded. We would expect that to continue. And we were, from an adjusted EBITDA basis, there is an earnout here that's tied to the acquisition of Voltrek. And when you strip that out, essentially for adjusted EBITDA, we were positive in the second half of the year. So that gives you an indication of kind of break-even levels in the business. And with another 10 to 15% growth on that, on top of that level, we expect to be profitable for the full year this year. So with that, Pat, I can turn it back for questions.
Thanks, Mike. Let me start by asking a question that came from the audience. When it comes to the pending LED mandates, do you have a market share in those states that is on par with your market share nationally?
You know, state by state is always very difficult to say what the share is. I can tell you that we're active in all of those states, not only on a turnkey basis, but also through partners. So we have agents, ESCOs. We feel like we've got good representation to take advantage of these trends.
Great. And then another question about the margins. Could you talk a little bit about the margins by segment? I know you mentioned that in the maintenance segment, you're going through a transitional period right now. But could you talk about the long-term margin potential by segment?
Sure. Perry, you want to take the
Sure.
margin question?
Yeah, after we work through the issues with maintenance restructuring, our expectation would be that the maintenance margins would be in the low 20s, 20 to 25% range, and then our expectation for the other two businesses tend to move pretty similarly. We ended Q4 with a 25.8% overall consolidated gross margin rate, and we would expect that the other two businesses would operate at that level, with the product being higher and their services component being a little bit lower. And then as we scale, we anticipate that for the current year, we've said that we expect margin to continue to improve as we grow sales, and have long-term said that we believe as we continue to scale, our gross margins could approach 30% overall.
Great. And then I think investors tend to like recurring revenue. So if we could talk a little bit about the maintenance segment, could you give a sense of the impact of a typical maintenance contract when we look at the scale of revenue relative to the initial business where you were also able to get the maintenance contract going forward? What's the scale of that revenue relative to the initial business typically? Like how much of an impact does a maintenance contract have to get that revenue?
Yeah, that's very difficult to answer because each situation is different. I can tell you that again, these typically are 3-year term agreements on the maintenance side, almost always fixed price. And so that was the issue that we ran into with the acquisition of Stay-Lite and the rapid inflation that we've seen over the last couple of years. So we had to make some adjustments there. Our legacy or our organic build maintenance to support our key account there is profitable, is a good account for us, good business. But overall, I would say that the maintenance area is not the only area where we have recurring revenue. It contractually, we have it on the maintenance side, but on the lighting side of our business and on the EV side of our business, we do a lot of work for the same customers year after year who are providing more and more projects. As an example, our number one customer, we did this $250 million project for them several years. We continue to do about 8 figures of project work for them every year. So it's not the same projects, but it's basically a recurring need for us to do projects for them. We have automotive companies, manufacturers that we relight every couple of years, facilities. So that's kind of a recurring area as well. So we do see maintenance, obviously, and maintenance is nice because it's contracted, but it does tend to be fixed price. So we've got to be careful in terms of how we go into that. And that's why we had to restructure to really get the business around what it is today. And we think it'll be profitable moving forward.
Great. And then I was wondering, when it comes to the maintenance clients, I think you have a slide that mentions some pretty notable large businesses that are examples of maintenance clients, Kroger, Walgreens, et cetera. When you sign a contract, a maintenance contract, you typically get all the locations in a certain region or all the locations in general. Could you give a little more detail as to the impact of signing a large maintenance client?
Yeah, oftentimes those agreements are regional. They could be regional, they could be individual stores, or they could be states. Very rarely do they provide everything to one supplier. There's usually backup suppliers involved in those types of things, but they're typically a state or regionally, kind of broken out.
Great. And then with regard to future growth, could you maybe take the three segments and classify them as growth drivers, short term, long term, medium term? How should investors think about the three businesses and how it'll drive growth going into the future?
Yep. So first, our lighting portfolio, which is our largest segment. We continue to feel good about lighting with all the things we discussed, regulatory and otherwise. We believe that we can drive double-digit growth in that category per annum over the foreseeable future. EV, our plan this year is close to 50%, and we do think that that'll be $30 to $50 million business in the next couple of years, which implies similar growth moving forward. So we see very significant growth coming from EV. On the maintenance side of the business, our focus there is to continue to grow it with customers who really respond well to what we offer, which is kind of this higher level integration of maintenance services and lighting. And so we want to continue to grow that. Obviously, it needs to be profitable, but the primary two growth engines for the business are going to be lighting and EV charging. I can say also within the lighting space, there are new avenues and business development efforts that are going on there to get us into some areas where we currently don't play as well. So we think those are both, and really from a strategy standpoint, right now we're looking at this as organic growth. Certainly from an acquisition standpoint, those would be opportunistic for us, but our strategy does not depend on acquisitions to realize the growth we're talking about.
Great. And we were running a little short on time. Let me see if I can squeeze one or two more in here. You did mention that the manufacturing takes place mostly here in the United States. So I was wondering if you could tell us a little bit about what are the pros and cons of doing new manufacturing here. If you could just touch on that a little bit.
Yeah, the pros are lead time. So we can stock common components and then customize those into finished goods at the last possible moment. That's why we have the shortest lead time of any of our peers of 2 to 3 weeks. The cons are obviously, there's costs. It's more cost efficient sometimes for lower end products to buy source complete from Asia. And so we do both. We manufacture where it makes sense and where we get paid for it. And for very cost competitive situations, we have the ability to buy finished goods.
Great.
From contract manufacturers.
Got it. And then as a final question that's related, if you could talk a little bit about the competitive landscape. And I know you mentioned the performance, your performance is right up there at the top. So I was wondering what do the competitors look like? How saturated is the market? That sort of thing.
Sure. I mean, there's always good competitors out there. And we have focused in terms of good, better, best strata. We've always been kind of the best player out there. We will continue to offer that level of performance. We have brought in some new product lines that are more competitive, that give us a broader view of the marketplace. And again, those allow us to be competitive at those levels and hopefully over time trade those customers up to higher specifications.
Great. Well, we're running up against our time limit here. So gentlemen, I just want to thank you for being here today, and thank you to everyone for joining us.
Yep. Thanks, Pat.
Thank you, Pat. Thank you,
It's been a great day.
Yep.
Bye.